Well, our next guest says tech's record rally has more to run. Let's bring in Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley. Mike, great to have you with us.
Thanks, Melissa. Good to be here.
Our panel splits down the middle in terms of being on board with this rally and not being on board. So what do you see bringing us higher at this point?
Yeah, look, I mean, I think obviously tech was the leader today. A couple weeks ago, it was the big cyclical bet. Are we going to make this big rotation to value or not? And I guess what I see is that we're getting tremendous breadth in the marketplace. A lot of folks, most people like to kind of quote returns year to date. But, since we went into a recession, I think you have to kind of restart the clock. That's what I look at for leadership. So what's been leading since the market lows on March 23rd? That was the recession low. And since that low, the order of outperformance is energy, consumer discretionary, then tech, materials, and industrials. And at the bottom of the barrel, it's staples, utilities,
it's Karen
healthcare. So it's basically a cyclical over defensive trade, and that's a very bullish signal. It's basically saying that we're in a new economic cycle, we're in a new bull market, and it's broad. And I think it's a constructive development.
Is there anything wrong with the way the market's structured in that five tech companies make up about a quarter of the market cap of the S&P 500? Because when you say it's broad, you're talking about the gains and not the weightings in the market. But structurally, should that be a concern? Guy was mentioning, a lot of these big stocks are in a lot of different ETFs. And so they get dragged up. And then, if we see any sort of dash for the exits, it's going to exacerbate that on the way down.
Yeah, look, I mean, I'll first want to admit that I'm surprised that that group of stocks is actually, holding up as well as it is, because usually when you get a new cycle, the former leaders tend to shrink in their contribution, but they're holding on to that. They're not outperforming so much, but they're keeping their own, the size of the market that they've had, and that's unusual. So I'm kind of in Dan's camp, where I do think there's been some excess in spending in the tech space. I don't think it's as bad as it was in the late 90s, but it's the same idea. There's been a little bit of an excess in CapEx in that area, and there's probably been a pull forward of demand, quite frankly, because those companies were the winners in the lockdown. And I think we'll figure that out later this year. That will actually provide some of the fuel to see some of the laggard groups continue to do better. So I don't think it's so much that tech has to go down. It's that it's unlikely that that group is going to be the traditional cyclical outperformer that it's been, because it never really had its cyclical downturn. It's been a beneficiary of the late cycle, and it's been a beneficiary of the early cycle because of the nature of this recession. And that's unusual, and there will be payback in my view.
You say the biggest risk to the market right now is fiscal stimulus not coming through. That implies that fiscal stimulus is priced in. So what sort of fiscal stimulus do we need to see in order for this market to continue its trajectory?
Well, that's right. I think a lot of folks are focused on the election now. Obviously, the virus still, maybe this trade situation, which, as Guy pointed out, kind of, caused a wobble last night. But for me, it's all about the extension of this fiscal package. If we don't get at least $1 trillion, which really means extending the PPP and the unemployment benefits through year end, you can forget about this rally altogether. I mean, you're going to probably have a double dip in the economy. Now, we think it will pass, okay? So that's our base case, but there's always a risk that we snatch defeat from the jaws of victory, and Congress is good at that. So I think that's the risk that we got to focus on. And if we get that, we could be, there's a chance we get surprised on the upside, that we actually get more than what we're expecting, which is about $1 trillion. These numbers are just gargantuan, by the way, when we say $1 trillion sort of cavalierly. But that's what we're getting, we think, and that will be enough to take the next leg of the bull market.
Mike, great to speak with you, as always.
Thanks, Melissa.
Mike Wilson, Morgan Stanley. Tim Seymour, it sounds like we could be setting up for a major rotation if what Mike says actually comes to fruition.
Yeah, I mean, we've had those rotation periods. I do think there have been moments in the last 3 months, and even before we went into COVID-19, where we did see banks leading, where we did see essentially industrials that were bombed out, the value over growth trade, and then growth over value. A month and a half ago on the show, we were talking about the other trade, right? So I think it's going to be very difficult to dethrone those 5 companies in the short to medium term. And I think as long as the liquidity is in the markets, it's going to be very difficult to not own those 5 names for people that are not in those names, and I think they could bid them higher.